Hello, everyone. Welcome to another Webinar Wednesday by Smartkarma. I'm Michael Tegos. Today, I'm excited to welcome insight provider Josh Du, who will use Uniswap as a case study to talk about ways to conduct fundamental analysis on cryptocurrency. Josh has been an investor throughout his career. He has experience in multiple asset classes in companies like Morgan Stanley and Deutsche Bank. Currently, his focus is 100% directed at identifying, investing in, and sharing investment ideas in the crypto asset class, as he believes this will be the fastest growing space for years to come. Although he's a major believer in the macro thesis of crypto, his research is bottoms-up focused and will break down key crypto investments into their fundamental components. So investors with institutional experience will be familiar with them. As always, please feel free to send in your questions for Josh throughout the webinar using the Q&A button that you will find on your Zoom app. We will do our best to get to them during the Q&A session at the end. Please do not reshare or reproduce the contents of this webinar without express permission. We will have a recording available on the registration page afterwards. With that out of the way, Josh, let me welcome you to the webinar. Thank you very much for being with us today. I'm sure everybody's looking forward to hear from you, so have at it.
Great, thank you very much, Michael, and very happy to be here to attend this webinar to share my research and analysis on crypto. So a little bit of my background first, and then maybe I'll talk about the history of crypto a little bit as how I understand it, and then finally we'll reach deep and talk about this case study for Uniswap. So for me personally, I think maybe some of the participants know me already in my previous life. So, as Michael mentioned, I've been an investor all my career, and mainly, at shops like Morgan Stanley, Deutsche Bank. My last gig was at Horizon. Before that, I was at Ninemasts. And the asset class I invested in professionally were primarily equities, as well as a little bit of credit. But personally, I've been interested in crypto since basically 2017. And unfortunately, crypto, it's very different from what I was doing professionally at work, where it was very much bottoms up, deep fundamental analysis, right, on the stocks, on the credit, on the companies. But what drew me into crypto is actually this chart, which is price action, right? So 2017, when I was at Ninemasts, a bunch of my colleagues were just looking at the Bloomberg terminals and watching this crazy thing going up, shooting up 1,000% year-to-date returns in 2017, and that was called Bitcoin. So before that, I had pretty little knowledge about Bitcoin. I assumed what everyone else assumed, where it's a tulip bubble, it's a Ponzi, and it will eventually pop. But the price action in 2017 really interested me as well as my colleagues. So we started doing a little bit more work, and eventually I invested some money basically at the top. And in 2018, 2019, lost pretty much 80-90% of it. But that got me extremely interested because I got my foot wet and I was doing work to understand crypto. And crypto back then, it was basically only Bitcoin. So the analysis that we did, and most people have done, is mainly just macro, right? So you have the bull thesis and then you have the bear thesis. The bull thesis is like, Bitcoin is anti-inflationary. It is a replacement for gold. It is permissionless. It cannot be regulated by the government with quantitative easing and stuff like that. Therefore, the market cap of Bitcoin should at least go to as high as gold, for example, or even higher, as what the bulls would say. But then on the bearish side, right, the argument is like, well, there is no intrinsic value. There is no real asset to this. There is no, dividend. It does not produce any sort of returns or profits or revenue. It is a Ponzi. It is a tulip bubble. We have seen this before, and it will eventually pop as well, right? So depending on which side you're on, the bulls, the bears, you measure your investments accordingly, right? But still, all of that was still very top down, very macro based, and it required you to have a view on the world, on interest rates, on quantitative easing, and stuff like that. But something really interesting happened between the end of 2017 to now, basically. If we look at this chart, right, in the years after 2017, actually immediately after 2017, what had happened was Bitcoin's dominance of the total market cap of crypto decreased significantly from 90% to 40% now. So this is a chart of crypto dominance, and the sort of orange line represents Bitcoin, which, as you can see in 2017, was hovering around 90%, and very quickly it dropped to 40%, where it is now today. So why did this happen, right? Why did Bitcoin's dominance decline? Well, this is due to the rise of Ethereum. So Ethereum and other sort of so-called layer one protocol coins, they were a innovation that's a little bit different than Bitcoin. With Ethereum as well as with other layer ones, what was possible was now the programming of money as well as the programming of protocols that sit on these layer one chains that could govern money. So Bitcoin, you can think of it just as a reserve currency, but Ethereum and the other layer ones, it was programmable. It become companies, it become applications. So now when you look at sort of the total breakdown today, and today's crypto market cap is around 3 trillion. So it's becoming a serious asset class. But if you look at the breakdown today, Bitcoin accounts for dominance. This is maybe a couple of days ago, I got the screenshot. Bitcoin dominance around 41.7%. Ethereum is around 20%, and the other sort of tokens make up the difference. And the analysis that we'll be doing today, which is more about the fundamentals, about the bottoms up of the way to look at crypto, it's all about these coins other than Bitcoin, because Bitcoin's arguably, there is not very much a way to prove intrinsic value, but everything else, Ethereum and including everything else on top of Ethereum, as well as other layer one chains, there is starting to become a way to use fundamentals and to use bottoms up analysis to analyze these chains and these companies, because they do have revenues, they do have users, and sometimes they even have profits. And so you could actually use traditional finance modeling techniques to forecast and to value these so-called crypto companies going forward. And so this is the why we're here. We're here to talk about the techniques that we can potentially use to analyze these crypto companies from a bottoms-up perspective. And to do that, I picked a DeFi token, right? So what is DeFi? DeFi is decentralized. It's a short form for decentralized finance. And what is decentralized finance? Decentralized finance was a subsegment of crypto that became popular after Ethereum, after the rise of Ethereum, because now for the very first time, programmers and hackers were able to make these programs or companies that's on the blockchain that have the same functionality as real world financial firms in the real world today, right? So when we look at this sort of graphic, you can kind of see that people try to link centralized finance, which we are familiar with, these icons, these logos, they are very big companies, and they linked it and they mapped it to decentralized finance protocols. So all the logos on the right hand side, I'm sure these are unfamiliar to a lot of people. All these logos are individual tokens and individual companies that actually serve the same function as a lot of the logos on the left hand side, right? So there's money, there's lending protocols, there's borrowing protocols, and there's banking protocols. And the case study that we're going to look at today is a company called Uniswap, which is under exchange. So if you look at the the middle of the graphic under exchange, on the right hand side, you see a pink unicorn. Well, that's Uniswap. So that exchange is supposed to sort of mimic the real world exchanges, NYSE, Hong Kong Stock Exchange, and allow the trading of crypto on the decentralized network. So, what is Uniswap? So Uniswap is the largest DEX. And what is DEX? DEX is decentralized exchange. How is this different than centralized exchange? Well, let's first look at the numbers, right? So if you look at the top part of this graphics, right now, the middle part, it says DeFi volume dominance, 5%, right? What this says is that out of all of the crypto volume, traded volume on a daily basis, DeFi, which are these decentralized exchange, their volume accounts for 5% of it, which means that 95% of it, 95% of the traded volume actually go through centralized exchange. And centralized exchange like Coinbase, like Binance, like FTX, like Gemini, right? But despite the fact that DeFi and DEX market share only have 5%, it's still pretty massive, right? So on the left side, you see that the DEX 24-hour trading volume is 9 billion. And this is just a random days screenshot I took that shows that there's a $9 billion of trading volume already on DEX, which is pretty significant. But if we break this down even further, right? So below that, there is a ranking of all the DEXs, all the decentralized exchanges, and amount of volume that they're doing, their market share. You can see right away that Uniswap is the #1 DEX in the world. So Uniswap right now runs 2 versions, version 3 and version 2. So version 3 is #1 and version 2 is #4. And if you combine the market share of version 3 and version 2, then the market share of Uniswap in the entire decentralized exchange ecosystem is about 40%, which makes it extremely large. And if you read my report, talking about Uniswap, you see that I think that this is one of the key reasons why I'm positive on this protocol, which is the network effect, because these decentralized exchanges require traders on one side and liquidity providers on another side. So the bigger you become, the more trader will come. The more trader will come, more liquidity provider will come as well. And then that will lead to additional listing of additional token, leading to additional traders to come and trade. So it's a very positive vicious cycle that I'm sure everyone who's looked at exchanges will understand. But in this case, in crypto, you not only have the network effect, but you also have the phenomenal growth, the underlying growth of the entire ecosystem, which is actually very interesting, and one of the reasons why I think that this is a winner for the long term. But let's go back to what the protocol is. So these are these DeFi protocols. They're called dApps, right? Decentralized application. It's a very fancy name for just a website. All you have to do to access and to use it is just to go to this link on this page, app.uniswap.org. Once you're on this page, you need to connect your wallet, your crypto wallet, right? It could be a hot wallet, it could be a cold wallet. But once you connect your wallet to this essentially website, then you could do crypto transactions. So I took a couple of screenshots, right? So the left-hand screenshot is just a transaction, where you're swapping between ETH and Ethereum, which is between Ethereum and USDC, which is that stable coin that's pegged to the US dollar. So you can assume that's just the US dollar. And that's all it is, right? It's very simple. It's very clean. It's not very sophisticated in the traditional trading or brokerage software perspective. But I'm sure they will make improvements in the future. But right now, all you have to do is you select the token A, and then you select token B, and then you click swap. And then you will swap token A to token B, and it is that simple. And of course, whenever you do that, Uniswap records the transaction, as their transaction volume. They earn revenue and they earn profits, and this is the way that these protocols actually have fundamentals. And on the right-hand side, right, this is the decentralized part of the decentralized exchange, meaning that these exchanges do not have professional market makers behind it. They don't have professional market makers sitting behind it with their balance sheets, trading, taking your trades for you. Instead, what you see on the right-hand side is the pool of USDC and ETH within Uniswap provided by other users, right? So this is the pool that me or you or anyone could go on this website. You can click on add liquidity at the top right, and then you could add your own liquidity to this pool. Then whenever a trader want to come to the to Uniswap and trade, which is on the graphic on the left-hand side, you provide the liquidity, they do the trading, and then you actually earn the spread as any market maker would, right? So this is how the decentralized exchange works. On one hand, you have the traders, which is the normal traders that we understand. But on the other hand, there is no market makers. The only market makers are the users themselves providing the liquidities into this protocol. Now, why would users provide the liquidity for people to trade against, right? Well, you actually earn the fees, right? So you can see that in USDC ETH on the screen, total TVL, which stands for total value locked, is 235 million. That means, there's enough people who put together $235 million and put it all into this pool. And for the, in the last 24 hours, the fees generated through trading in this pool was, $259,000 US. And this money is actually distributed to the liquidity providers. So they actually earn a fee as any market maker would, right? By contributing capital. So this is the other side of the decentralized exchange. And it's very interesting because this is a USDC ETH pool, and there's, hundreds of pools on Uniswap. You can just see it when you go on the website. And you can actually decide what pools, if you want to be a liquidity provider, you can decide what pools you want to provide liquidity for, and you can actually see the corresponding fees that you could receive as a liquidity provider. So in many cases, these yields, right, these liquidity providing yields on an annual basis, they could be very high. They could be 20% or even more. Some are even triple digits. So it's not a bad way to actually make some passive income if people are just very positive on some of these tokens. They're willing to hold it long term anyways. And in the meantime, they don't mind using this to provide liquidity for people to trade against. So, this is the decentralized part of this protocol. But all of that, all of this is, all this data actually translate into fundamentals. And because it's actually on the blockchain, is transparent, anyone can go in and pull the data, which you can see on this page. So this is at the top, right? So it says Uniswap monthly volume, right? So this is traded volume in terms of US dollars, and that's in terms of billions, right? So in November alone, looking at the chart, that's about $80 billion of volume that's traded through Uniswap. And in December, you can see that it's a little bit above 20 billion because this chart is tracking it real time. So this is December month to date, right? Which means that it's very interesting, right? So in a traditional way of analyzing companies, analyzing, stocks and credit, you're waiting for some kind of announcement from the companies. It's, audit reports or monthly updates or whatever. But on the blockchain, the unique part of it is that everything is done in real time and everything is transparent because everything is on the blockchain. So anytime you want to see anything, you can go on the blockchain and pull the data if you actually know how to do it, right? So to pull this chart, I pasted the code on the bottom left as well, right? So this is just the code. There's 8 lines of code which I wrote that pulls the monthly volume, traded volume data for Uniswap. And you can be a lot more elaborate, but it just shows that how simple it is to kind of pull that data and pull that code. And this graphic shows that on a daily basis, I kind of compared Uniswap Coinspace with Hong Kong Exchange SGX. Uniswap, like right now, on the daily basis, about $2.5 billion volume, which it's already a pretty big sizable exchange relative to others. And of course, you can just pull all that in real time. And with that volume, right? The volume, how does that translate into revenue? How does that translate to income statement? Well, you could take a look at a more elaborate dashboard, right? So this is coded, into the blockchain as well. You can use code to actually pull down the revenues, the profits of the protocol. And so in a normal company, in a normal equity or credit, right? The way we look at income statement is like, okay, the amount of volume sold multiplied by ASP, right? And the volume and the ASP is determined by supply and demand in the market. If I was a widget maker, I need to look at other widget makers and assess how much widget I should make and what is the pricing of my widget. And all that, strategy and company direction is very complicated. But the top line in crypto is very simple. It is all programmed into the protocol. So no matter what happens, you can just go into the code and look at how much revenue these protocols are actually taking. And in Uniswap's case, it's about 0.18% of traded volume. So about 18 basis points, of like $100 that's traded. And this is just in the code. They it's public. They tell you about it. You can go through the codes and verify that this is indeed how much that they're taking as a take rate, right? So that's the revenue, and it's very simple again, and you can actually pull it down on a daily basis. This is on a 7-day basis. You can pull it down on a daily basis or even hourly basis, and then you can actually see how much revenue this protocol is generating. And then what happens, right? So in a typical company, once you have the revenue, then you're talking about cost of goods sold, and then you have gross profits. Then you have to subtract OpEx, interest, all that stuff like taxes. Then you finally get to a profit number. Well, in crypto, crypto protocols, again, you don't have any of that stuff. You don't have these cost lines. All you have is again a programmed line for profits. So in this case, for Uniswap, the profits, it's 1/6 of the revenue. So take whatever revenue that's being made by this protocol, and then you divide it by 6, and that's how much profits that's going to the token holders. Again, it's programmable. It's in the smart contract, and you can pull it down on a daily basis. And so if you look at the spreadsheet chart in the bottom, the blues are hard coded, the reds are a little bit my forecast, but you can actually model out exactly how much volume, how much revenue, and how much profits this protocol is generating. And this is it's very different, right? It's very different from a normal income statement from a company, but this is how it sort of works in the crypto protocol. And this is still okay, because next we will look at balance sheet, which looks completely different than a normal company. In a normal company, right, once you make that revenue, once you have the profit turns into cash flow, right? The cash flow goes into the company takes that cash flow and then make additional CapEx or investment to it, right? Well, first of all, in crypto, there is no cash flow statement, because all the revenues and all the profits are recognized right away. There is no inventory days, there is no like payable days, receivable days, stuff like that. Everything is recognized instantly on the revenue line, as well as at the profit line. So there is no cash flow statement to kind of like translate between profits with cash flows, right? And not only that, there is no cash flow statement. There is no retained cash or retained earning for these crypto protocols, because you can think of it as a way that everything is paid out. Then the question is, if everything is paid out to the liquidity providers, to the token holders, then how do you develop, how do you invest? How do you further develop the company, the protocol, right? Well, in crypto, there's a concept called the treasury. So you can see here in the chart, this is the Uniswap treasury. And again, this is public. It's in code. You can pull it up anytime you want. And what this is that a certain amount of Uniswap tokens was set aside when it first went public. And these tokens that were set aside went into the treasury. And this treasury is intended for purposes to further develop and invest in the protocol. And the treasury ownership is actually owned by the token holders. So if you're a token holder, you can actually direct the investment of this treasury by voting on governances and voting on and proposing new governances. So here you have a website, gov.uniswap.org, right? So if you go onto this website, you can actually vote on anything related to Uniswap future direction and investments. And you can also propose to have new Uniswap initiatives that would benefit the protocol, right? And once you propose it, then all the other Uniswap holders, token holders, would actually vote on it. So very much like equities, but this is again done real time, like 24/7. People can propose new proposals anytime they want, and you can vote on it anytime you want. Again, extremely transparent. So at the bottom right corner, you can see that this is called ETH scan. So this is basically a website that allows you to kind of dig into the blockchain, and you can see that this is the wallet, right? This is the cold wallet that contains some of the treasury, and then you can actually click into the wallet and you can see exactly how much money the wallet has. This wallet right now have about $3 billion of Uniswap tokens as a treasury, which is quite similar to what the numbers show. So again, if that money is spent, you can actually track it as well in that website. So it's very it's very different, but it's very interesting way of looking at income statement, cash flow statement, as well as the balance sheet between a crypto company and versus a typical sort of equity and credit company. And not only that, you can look at the valuations, right? Because this thing have profits, this thing have revenue. So you can actually do a valuation. And there are various providers that actually look at the valuations. Of course, all the valuations here is done on a past basis, right? There is no sell side in crypto. There is no Goldman Sachs making EPS predictions for Uniswap, a year later or 2 years later. So there is no forward multiples. There's only backward looking multiples. But despite that, you can kind of see that there is a little bit of pattern here, even in the past 1 year, very short track record. But at least you can actually see that on a PS basis, it kind of typically trades between 8 times versus 32 times. Very volatile, but that is crypto. It is very volatile. But again, there's ways to use valuation, even from the traditional world, to value these companies. And of course, there's a lot of valuation methods from crypto natives, right? So there's ways to value it using TVL. There's ways to value it using realized market cap. So there's a lot of different ways to value it, and it's very much a different sort of valuation metrics and technique to learn to kind of dig into it and understand how to price these assets. And next, we need to talk about the risks, because I mentioned the process of how to look at the fundamentals, and I mentioned the differences, right? And all the differences are pretty much versus equity versus credit. Like all the differences are pretty much risks, but there's a couple of risks that really need to highlight. So risk one, top left, right? This is a screenshot of GitHub for Uniswap. So what is GitHub? GitHub is a place where you deposit all your codes, right? Why is this a risk? The risk here is that all of the code for Uniswap, Uniswap is just an application, right? So all the code is actually open source, meaning that anyone can go and look at the code. Anyone can go and copy the code and paste the code somewhere else. If people have coding experience, they can go and create another Uniswap in days. So I try to kind of copy Uniswap as well. You can do it. It's very easy. Everything is online. It's all public, right? Which means that where is the barrier to entry, right? anyone can go and just replicate your product. In fact, people did, right? There was a case where SushiSwap forked Uniswap and then took away billions of dollars of TVL. And cases like that still happen. So that's one of the risks, is that if you don't have IP and if you don't have a way to protect other people from copying your code, then how do you erect your moat, right? So the answer to that is, at least so far, is that the moat in crypto is mostly based on network effect. So the more people you have using the protocol, the more sticky the protocol becomes, and the big gets bigger, right? Because as we mentioned before, the more liquidity a protocol has, it incentivizes more traders to come, and with more traders to come, it generates more fees for the liquidity provider, so that more liquidity provider will come, and then more tokens will want to list on your exchange, and then it's a very huge positive feedback loop. This is one of the reasons why, despite the fact that everything is open, everything is free, like the code, right? Uniswap is still a 40% market share owner of DEX, and that's a testament of their ability to grow the network effect and leverage it. But still, it is a risk, right? So anyone can go on this website, you just search GitHub Uniswap, you can click into it, and then you can have all the code. There's no secret here. So something for the traditional investor to definitely be mindful of. And and then more risks. On top right corner, I have a paste of the screenshot of SEC investigates Uniswap. So regulation is going to be a key topic in crypto, as well as DeFi, as well as everything else, right? Crypto is very interesting, where the entire idea is very anti-government. So for governments to investigate, to lay down regulations to govern crypto is very sensible. And I do believe that in the future, there'll be more and more regulations. There'll be more ways for governments to kind of handicap the development of these protocols and the crypto as a whole, which is a risk that people need to be aware of, because that should be their base case scenario, that there will be more and more regulation. Now, the question is, how much regulation, and do the regulators really want to destroy the entire sector? My personal view, I don't know, right? But my personal view is that I think there are regulators who want to work with crypto, who want to work with the entire ecosystem to help regulate it, but as well as encouraging innovation to help grow it, right? But again, this is something that we need to have a wait and see attitude. Regulators globally are very behind the curve in terms of crypto. But again, usually regulations follows innovation, right? So we'll have to just kind of wait and see in terms of development on the regulation side. But again, another risk to highlight, right? And it's not a very small risk either. And the third risk is bottom left. This is a chart showing the total hacking incidents over the past couple of years. And 2021 showed the biggest spike of money lost through hacks, right? It's close to $8 billion, right? This is pretty significant. And most of that is lost through protocols like, DeFi protocols, where, they take your money, they trade your money for you, and it gets hacked. And then boom, you lose all your money. Because at the end of the day, these protocols, these companies, they're just programs. So if there is a bug in the program, then it could be exploited, and hackers who actually know how to do the hacking, they can go in and steal your money, right? So again, this is something to be very well aware of. But Uniswap is so far very secure. Gone through multiple rounds of security audits, and they actually have some of the best developers. So at least for Uniswap, this risk is relatively low, but something still to be aware of. And the final risk that I personally have an issue with as an investor is that this is Hayden Adams. He is the founder of Uniswap. He is 27 right now. He founded this when he was 23. And the problem here is that there's no transparency around the leadership and the management of this company, right? So it's headed by Hayden Adams. We barely know who else is sort of on the team, right? It's not very public. It's not very transparent. We do not know their compensation structure. who do not know their incentive structure. So how do we as investors actually track their direction, what they want to do, and how they think about their own involvement with Uniswap, right? In a typical company, you have boards, you have meetings, you can actually track these public figures. But in crypto, a lot of these protocols are very much hidden or not very transparent in terms of accessing these people. So again, that's another risk that people need to be aware of when they invest in protocols. I mean, luckily in Uniswap's case, their backers, their VCs are very prominent, like A16Z, like Anderson, Horowitz. So the assumption here is that they're the they're holding Hayden's hand and trying to manage it in a respectable way towards the future. So there are some mitigation to that risk, but again, these are all very serious risks that people need to think about because it's very, very different than investing in the traditional world of equities and credit. These are some of the risks that that's not really within equity and credit, but they're new in crypto and something to be very aware of, right? And with that, I mean, that kind of concludes my presentation. Just to sum it up, right? The idea here is that crypto is a very fast-moving sort of sector segment. There's various macro reasons as well as various bottoms-up reasons why the growth is so phenomenal, right? And it just so it happens recently, right? The segment is the sector is no longer just purely macro. There's a lot of protocols that have revenue, that have profits, that you can actually do a bottoms-up analysis, forecast, value it, and provide a range of valuations on these companies. And that's actually very interesting. But the difference is massive between crypto companies and real companies. Income statement, cash flow statement, balance sheet, all the accounting is extremely different. And all the risks that I mentioned before is something that, is very different as well. So it's a very interesting journey and very, very interesting for a, someone who's an investor and analyst to kind of analyze and dig into. But, it's I think it's definitely worth everyone's time to kind of pay more attention to this going forward. And with that, Michael, I mean, we can open up the floor to any questions.
Thank you very much for this, Josh. This was a very thorough presentation and very interesting stuff. As we wait for any questions to come in, I guess one thing that I'm curious about is you have described something that's I guess a little bit more complicated than your average fundamental analysis for that investors are sort of used to. And my question was, how much of a specialty knowledge does an investor need to have in order to perform to actually pull that data and be able to read it? For example, a person in the audience asks, where do you paste those codes? Right, so it can get as basic as that, right. And just kind of on top of that, have you seen any resources pop up that kind of do the work of pulling that data for investors, since it's all public and available?
Right. I mean, that's a really good question because as it is with every single asset class, right? Every single asset class have its own set of tools, right? So even, for professional investors who's familiar with equities, with credit, right? They actually had to learn how to use Bloomberg. And, when people graduate from college and they enter into asset management industry for the first time, it took them a long time or maybe a little bit of time to understand how to use the commands on Bloomberg, how to pull the data, how to download the annual reports, right? How to call into the conference calls, right? And how to use Excel, basically, right? How to write macros and how to do modeling. So that tool is for the equity and credit asset class, but for crypto, there's a new set of tools, and that's basically all it is. It's just another set of tools, and another set of tools. It's very, it takes some time to learn, but trust me, it's no more difficult than understanding accounting. Accounting is very difficult. This tool is not more, it is difficult, but it's not more difficult than accounting, I would say. And your second question in terms of are there more these aggregator tools that, resources that allow investors to use it? Well, yeah, I mean, so on this site, right, where I pulled down this data for the monthly volume, this is a data analytics website called Do Analytics. And what it is that it enables people to write simple codes like this to pull down from the blockchain. And this code is very simple. It's just 8 lines in SQL. It's very easy to learn as well. So once you learn it, you just put it into, anyone can just Google Do Analytics, right? You can just click on, you can just open it and you can start writing in commands right away. And then you can start pulling down this volume. And there's a lot of sites like this too. Unfortunately, there is no Bloomberg for crypto yet, where everything's aggregated, but I am pretty sure that in the future that will happen, and we will have a much easier way to pull the data. So instead of writing code, I imagine like in a year or 2 years time, you can just press a button and then you can just download this right away. The innovation and the technological changes here is happening really fast. So I'm very confident that it will become even more investor friendly in the future.
That's a great answer, actually. And thank you for making that clearer, because I can see how it could get complicated pretty fast. But it seems like things are might be simpler than that. Another question from the audience is, so you have provided a way to do fundamental analysis on Uniswap, which is an exchange. Is there any way to make fundamental analysis on individual cryptocurrencies, such as Bitcoin or Ether or the like?
Yeah, I mean, really good question. And so I sort of, talked about this a little bit at the beginning, where I mentioned, originally Bitcoin is very much a macro play. There's very little intrinsic value that you can actually prove. It's more of a belief system that, you think that there's value there, and then other people will think that there's value, and then, you replace its gold. But for protocols like Uniswap, where you can actually have revenues, you have trackable profits, then that's where you can do fundamental analysis and bottoms up analysis. So for Bitcoin, you can't really use that tool to prove it. For Bitcoin, you actually have to do a more of a top-down analysis to look at macro, like most people look at macro, look at gold, look at quantitative easing in terms of the debasement of currency to understand, what the value it is for Bitcoin. Now for Ethereum, you can actually use this bottoms up framework as well. Ethereum and Polygon and Avalanche, anything else. It is a chain that also generates profits, that generates revenues whenever there's activity on these chains. For Ethereum, for example, the activity for Ethereum recently in the past couple months spiked because of all the NFT minting, NFT selling of the NFT craze, right? And that created a lot of revenue for Ethereum token holders and miners and stuff like that. So there's a way to do it for Ethereum from a bottoms up perspective. And you can actually go through this entire process and actually do it for Ethereum. Although, it's much more difficult because there's a lot more drivers for the entire protocol, for an entire chain than just a single protocol like this. But for that, it's you can actually do it using this process.
Thank you for that. Another question is, what risks are associated with market making at decentralized exchanges? You talked a bit about the, some of the fundamental risks, but what do you think about this one?
I think it's very risky. So you don't really earn 20% or 3-digit yield by taking no risk, right? It's actually pretty risky, and there's a couple of risks, right? So first of all, the risk is the platform risk, right? So I guess the counterparty risk. When you actually staking your coins into the DEX, you're making an assumption that Uniswap is going to be around and return the tokens to you, right? So in the case of Uniswap like goes down or it gets hacked, then your counterparty risk materializes and you can potentially lose that. Although, I mean, that's a very low risk and that's probably one of the worst risks possible, that you lose everything, right? The second risk is that you're just taking principal risk, right? You're taking inventory risk. Let's say if you're staking, you're market making like Ethereum, USDC, right? Because you have to buy it to stake it, then anytime that Ethereum price goes down, you actually lose money. Now, hopefully your market making fees will compensate you, but it might not, right? So here you're actually taking principal risk on Ethereum. Another risk, which is very gets a little bit more technical, but it's very much crypto related, is a thing called impermanence risk. So how the market making works is that when you deposit 2 coins, right? You always have to stake 2 tokens. When you deposit 2 tokens initially, it has to be on a 50/50 ratio. But what happens if one token's price starts to spike, right? Then what's happening to you as a market maker is that Uniswap is slowly selling your token that's increasing in price and buying the token that's not increasing in price as fast. So essentially what you're doing as a market maker is that you're selling the winner and then you're buying the loser, which, a lot of people are not very comfortable with. Because, for like trend following traders, you actually want to buy the winner and sell the losers, right? So that's another risk. There is no risk of losing money in permanence risk, but you actually, you're missing out on additional upside with that risk. So those are a couple of the key risks. I would say still the biggest risk is the risk of being hacked, right? And that's another reason why protocol like Uniswap is so popular. It has 40% of the market share. So it has proven itself that it can survive through hacks, through these bull and bear markets. So people are willing to put their liquidity into this protocol versus like some new upstart. It's very difficult to trust a smaller exchange, without the time and the track record that they have. So yeah, these are the risks, but very, very worthwhile thinking about. Yeah.
Thank you for that. Another attendee thanks you for the presentation, which is brilliant, they say. And they have 2 questions. So question 1, would you mind sharing your take on Uniswap's current valuation versus your base or bull case projection? And the second question is, if the thesis is that crypto continues to gain adoption, what's your view on Coinbase's positioning on the market? Can it coexist with Uniswap, or are they destined to compete? Can Coinbase step on Uniswap's territory since the latter's code is open sourced?
Sure, great questions. Obviously, very informed question as well. So in terms of valuation, right, how I think about it is actually very much from an equities perspective. So, and I think about it in terms of, how much money I could lose and how much money, I could actually make, right? So in this case, it's pretty clear that valuation is on the cheap side versus historicals, right? So all I need to know and all I need to believe is that the valuation will hold its current multiple while the protocol continues to grow in volume and grow in profits. Then I will just make money from so-called EPS growth instead of multiple expansion that may or may not happen. And if we kind of model out the crypto adoption and the trend of trading volume growth for Uniswap and other exchanges, we're talking about probably like 100% or maybe a little bit less than 100% growth on an annual basis. So if I can just make that on this token, then I don't need to count on multiple expansion to give me the extra kick on returns, right? But with that being said, it's always good to see multiple expansion, and multiple expansion is really dependent on the flavor of the day, right? And capital within crypto, as well as within other asset classes, rotate pretty furiously. So you don't really know when one day capital is very much interested in DeFi or very much interested in metaverse or GameFi. There is a ecosystem within crypto where capital is actually shifting from sector to sector, and so I think there is a chance for multiple expansion in Uniswap. I don't know when or how. But that's the beauty of it, is that I don't think you need to be right on this in terms of timing to actually enjoy the fundamental growth of the volumes. And for the second question, I think it's competition versus Coinbase, right? So Coinbase is a centralized exchange, and if we look at one of these charts, is that DeFi is very small. Like DEX is very small right now. It's only 5% of total traded volume. So, Coinbase is part of that 95%. So Uniswap is not really a competitor versus Coinbase. Coinbase is a competitor versus, Binance versus Gemini versus all the other centralized exchanges. But for people who want to trade on Uniswap, they're very different than people who want to trade on Coinbase, because on Uniswap, for example, you don't need to provide KYC. There's a lot of anonymity, and at the same time, you actually have to be a little bit more technical, right? You need to know how to set up a cold wallet, how to set up a hot wallet, how to take ownership of your passcode, how to find the token address that you're going to trade. So it's it's a lot more technical than Coinbase, which is similar to any sort of brokerage. You transfer money in and then you can start trading crypto. So I would say right now, they're not in direct competition, especially since how small decentralized exchanges are. But in the future, could they compete? Sure, it could compete, but that's really not anytime soon right now. So I think right now you kind of ignore the fact that they might compete right now. Yeah.
Got it. Thank you for that. Another question is, there's quite a lot of protocols out there. There are new ones and there are ones that have existed for some time. How would you evaluate if a protocol would continue to be successful or it would drop off?
Very good question. So protocols, I assume they're talking about layer one chains like Ethereum or Polygon, or it could potentially be like things like Uniswap, right? And again, I think so when I look at crypto, the biggest thing I look at is network effect, because in this hyper connected world, right, it's all about the community, it's all about the users who are willing to stick with a protocol, with a chain that kind of drives further user adoption. If there is no community behind it, then there will be no further adoption. So first, you need to look at who's using it, how many people are using it, and then I think it's about the product that they deliver. So for Uniswap, for example, they have upgraded a couple versions. Now it's version 3, which it's quite innovative, which means that people have a reason to continue to use it. So I guess like fundamentally that's how you could track, but then technically there's a lot of on-chain data that you can use to track how popular something is and potentially how popular it could be, right? So one of the things that you can track is TVL. TVL is just total value locked. It means that how much liquidity are people willing to stake into this protocol. And it's a huge vote on the confidence of this protocol because it's actually real money. So for Uniswap, I think right now TVL is about 10 billion. It's one of the biggest, and that gives you a sense and the trend of that. You can actually watch the trend of this. So if the TVL trend is going up, then you can actually make a assumption that people are willing to stake more and more money into this exchange, this protocol, and people are favorable for it. There's other on-chain data, like how many owners of Uniswap there are. You can actually go to this website. You can pull down the list of all the token holders. You can track how many token holders, right? If a token have 100 holders versus a token who have 1 million holders, right? You can easily see how popular it is. And then of course you can track the increase in the token holders individually, right? To get the trend. If Uniswap is, going up in a very nice trend and all of a sudden drops down massively because token holders all sold, then you can kind of tell like, oh, maybe there's something wrong with adoption, with people's perception of Uniswap. And there's tons of other stuff too. On-chain analysis is a complete different way of looking at the tokens from a technical and a quantitative basis. But yeah, there's a lot of ways to look at adoption and try to use that to make a forecast about the future of these protocols.
Thank you for that. Maybe I'll take a couple more questions before we wrap it up, since there's clearly quite a bit of interest on this. So one question is Uniswap an inflationary token or a deflationary token? And if so, what is the estimated inflation per year? Can we talk about Uniswap as a token? I'm not sure.
Yes. So Uniswap is a token, it's deflationary. So basically, you can actually see it in my report if I just pull it up. It's actually in part 2 where I talk about the tokenomics of Uniswap. Basically, you can see that. Let's see. Let me take a look. So 1 billion. When it went public, essentially in September 2020, 1 billion Uni tokens was created, right? And this is basically the limit of the tokens. So meaning that, there's not going to be tokens that's dropped to people that's above it, right? So sorry, what was the question? So is it just inflationary and deflationary? Well, basically it's capped at 1 billion Uni tokens. Yeah.
Right. Yeah, I guess the question is, if it were inflationary, what would be the estimated inflation per year?
Oh yeah, so that shouldn't apply here. I believe that it's just only 1 billion tokens dropped initially, and then what happens is that there's locked and freely circulating portion. So the freely circulating portion are basically what people use to calculate the circulated market cap, and the locked portion is on a vesting schedule that gradually vests over time. But the total amount of tokens, that should be 1 billion. Yeah.
Got it. Thank you very much. Another question is valuation. The attendee says that valuation can only be calculated if the number is genuine. Is it possible that exchanges can fake transaction volume since there is no regulator or third party to verify?
Yes, very good question. So this is a critical point for centralized exchanges, but it is not a point for decentralized exchanges. And the reason is because for decentralized exchanges, all of the transactions are actually done on chain, which means that any one of us could go into the protocol, click a couple buttons and see exactly how much trade or money has actually gone through the blockchain. And all of that is immutable. It cannot be changed. And that's the power of the blockchain. It's immutable. It cannot be changed by anyone. Once it's done, and it's very transparent. So for a decentralized exchange, all the volumes are 100% real, and there's absolutely no way to fake it. But for a centralized exchange, like a Binance, like a Coinbase, like Huobi, it's very easy to kind of like inflate the volumes, and those companies. Well, I guess Coinbase is audited now, but a lot of these exchanges are not audited. It's very difficult to actually track the validity of their numbers. So that is something to be worried about. But for everything DeFi, it's completely on chain and completely transparent.
Got it. Thank you for that. And finally, what are some of the ways that token holders get distributions of profits or revenues from different protocols? Asks the attendee.
So that's a very good question as well. Very good questions all over. So actually, there has not really been a very good way to solve this problem of how token holders will actually get the profits from the revenue, right? From the protocol. So when I mentioned that Uniswap, pays out 18 basis points, the revenue take rate is 18 basis points, and the profits 1/6 of that. That is not even turned on yet. And as a token holder, you actually do not get that 1/6 of the revenue as profits. What is happening here is that the community, all the token holders, have elected to not turn this on and elected to not take this 1/6. In exchange, they want to give this profits to the liquidity providers to incentivize them to provide even more liquidity, right? So they're just basically saying that, oh, don't give me that dividend, use that dividend and pay the liquidity providers. And so that liquidity providers will put more liquidity into the protocol. And then in the long term, that would be more beneficial for my tokens, right? But in the case that one day the token holder decides that, oh, okay, we want that 1/6 of the profit now. All they have to do is go into the governance, vote for it, all agree upon it, and then they will start receiving that 1/6. Now, how do they actually receive it, right? Right now in the market, there's essentially 3 different ways. One way is that you just receive it directly, right? The protocol just airdrops you additional tokens, and then you receive it in the form of Uniswap. Another way is that the protocol will actually go out there into the market and buy back tokens, every day or every month. And then with the buyback, they burn it. So they destroy the tokens. So essentially it's like a company, right? Doing buybacks and then canceling the stock, thereby increasing your proportion of the company as an equity holder. So those are basically the 2 ways how the token holder will get access to that profit. But there is no one consensus way of how to best to do it. So it's very interesting, very, very experimental, but it is something that people really care about. But again, it's like a hyper growth company as well. Like people are not too worried about sharing the profits yet, because people are thinking about the growth, right? People are thinking about long-term growth. Amazon 10 years ago, you don't expect Amazon to pay you a dividend because people wanted the growth. But it is something that all the crypto people are actually thinking pretty hard about. Yeah.
Got it. Thank you very much. And there you have it. Thank you very much, Josh, for this very educational presentation. Thank you everyone for attending and for sharing your questions. If you are on Smartkarma, I definitely recommend that you check out Josh's reports on Uniswap that elaborate on a lot of what we talked about here. And of course, follow his profile on Smartkarma to see more of his insights. If you have any other questions, please email us at research@smartkarma.com, including anyone whose question we didn't manage to get to today. Josh, thank you very much once again. This has been a particularly great session, and thank you everyone for being here with us.
Thank you all. Bye.